President Mohammadu Buhari on Friday, the 31st of December 2021, signed into law the 2022 Appropriation Bill, now an act, alongside Finance Bill 2021, in order to keep faith with the January to December budget cycle introduced by his administration. The Finance Act, which will usher in a new era of tax governance in the country, proposes amendments to some tax and fiscal laws to promote economic growth, attract foreign investments, and increase government revenue. The act, which seeks to remove multiple taxation in various segments of the Nigerian economy, will encourage the growth of the economy, especially through SMEs, hereby providing incentives for investors to invest in the Nigerian market and stimulate investment opportunities. It is important to note that, like every other law, Finance Act 2021 is likely to come with its challenges and, of course, opportunities for businesses and individuals. Therefore, taxpayers are advised to seek professional guidance in order to understand how the finance bill will impact their business operations going forward, and any new compliance obligations to be discharged or benefits to be enjoyed. Well, to help understand this, of course, the pros and the cons of this new act, I have joining me live in our Lagos studio. Well, he's a lecturer. He's been a lecturer for years. Well, he's a managing consultant at Pedable Professional Services. Thank you so much. Limited, yes, Professional Services Limited. Thank you so much. Oh, okay, Professional Services. Yeah. Okay, I got that now. Pedable Professional Services, Mr. Albert Folorunsho. Good afternoon and compliments of the season.
Thank you for having me. Good afternoon.
Yes.
Happy New Year.
Yes. Earlier today, coincidentally, the minister broke all of this down earlier today, the budget and the Finance Act. And she stayed so long on the Finance Act because obviously that is expected to change the way we've been running things before now. But before we go into specifics, can you just tell us, outline the highlights of this act?
Thank you very much. Let me start by congratulating the President, the Finance Minister, and of course the National Assembly for yet again making sure that the finance bills become law. And so we have in 3 years in a row a Finance Act supporting the finance, the national budget. That is a very good thing to have, and we hope that culture will continue. Now, in terms of the specific provisions, by way of highlight, the Capital Gains Tax Act, was amended a little bit. That has to do with disposal of shares. Okay, and I will give details on the triggers, the provisions around that. And again, if you go to the Companies Income Tax Act, CITA, several amendments were also made regarding the issue around the minimum tax, regarding turnover tax by non-resident entity, restriction on claim of capital allowance when you have exempted income, treatment of capital allowance when it relates to small businesses and medium-sized companies. Several other provisions were amended under CITA. Then we also have the FRS Establishment Act. Okay, two significant amendments. It gave power to the FRS to now deploy third-party technology. The old provision says purely proprietary technology, but now they can deploy. But of course, there are also restrictions. They need to take into consideration the position of the taxpayer and give them a notice. Okay, the second significant thing about the FRS Establishment Act is that gave them more or less precedent power over the administration and collection of taxes. Okay, which the minister even mentioned that there are other agencies who have attempted to encroach into the role of FRS by collecting, not only assessing and collecting tax. Okay, so by this law now, it has become, there are provisions which involve imprisonment for any of the other agencies or any persons involved in those other agencies who attempt to encroach into, the very revenue that the federal government has been craving for, now being attempted to be collected by other agencies. Those are the two significant provisions in the Establishment Act. Again, in the Stamp Duties Act, two provisions there again. One has to do with all the stamp duty that has been collected from 2016 on this electronic money transfer. There is a provision that says that within 30 days of signing of this act, whatever has been accrued must be distributed. Remember, the distribution was to be 85% to state, 15% to the federal government. I'm sure the state want the money as quickly as possible. And that subsequently, going forward, okay, at the end of each month, within 30 days, whatever is collected in terms of electronic money, transfer, the 50 naira that is being charged must be distributed, as specified in the law. We also have provision relating, amendment in the VAT Act, that has to do specifically with non-resident entity and other entity that are operating, into Nigeria, and has to do with requiring non-resident company, we have business to business and then business to consumer. The focus majorly is B2C, which is where individuals, buy things online through digital transactions. That is difficult for FRS to track those individuals that are, the minister use Amazon as an example. If you buy books from Amazon online, okay, the responsibility now by this provision is now shifted to Amazon to register, be agent of government, collect the VAT and remit to the federal government. Of course, the FRS has also been given power to appoint some specific, businesses in Nigeria who can still withhold VAT on their transaction. But the focus is majorly on B2C.
Well, a good way to start up the conversation. But gains on the disposal of shares was exempted from the CGT since 1998. When I do checking back. Now, what could be the reasons for this reintroduction, and what would be the impact of this, of course, on the capital markets for both public and private quoted companies? Very good question.
Of course, like you said, for the past 23 years, effectively 1998, gain on sale of shares, has been exempted from tax, okay? But the introduction from what we can see, because there is now a threshold, which means government is actually focused on portfolio investors majorly.
Okay.
Even though we have observed that the threshold has now been reduced, is no longer more or less focused on portfolio, more or less on everybody now. But the intention was to ensure that those portfolio investors don't just invest and go, and exit the market just like that without paying any tax. Okay, so for me that is probably the main reason why this has been introduced, and the fact that government is also interested, is also in looking for revenue. Okay, and so what it means is that when you sell your shares now, okay, and we need to ascertain how much it cost you and then how much you have sold it. The cost will include the commission you pay to your stockbroking firm who has helped you to buy. And of course, when you sell, we also have to take into consideration the cost of sale, apart from the actual cost, and then you find the difference, okay, which is the disposal proceed less the cost of acquisition. Then you have what we call chargeable gain, and then you apply 10%. Unfortunately, in Nigeria, inflation is not taken into consideration. We don't have inflation deduction, so that becomes the gain. But the important thing to note is that this will be based on if the disposal proceed is above 100 million in a 12-month period. Okay, if you are still within 100 million within a 12-month period, whatever gain you make on that disposal will not be liable to CGT. Again, if you dispose and you reinvest, which means you dispose, maybe you dispose shares in a company A, and you use the proceed to acquire shares in another company or even within the same company. Okay, the gain you made on the initial disposal will be shifted until you dispose the new acquisition. In under the capital gains tax, we call it rollover relief, where the process of sale of an old asset is reinvested in the acquisition of another asset of the same class as the old asset, which means you cannot sell shares now and buy a vehicle and say it's rollover. No, you must buy another. We really want the money to be retained in the capital market. So it is only when you are outside of all of this that the gain will become taxable. But of course, there are also exemptions. Sale of government security, bond, treasury bill, certificate, they are all exempted from capital gain. Okay. It is only sale of shares. And of course, when we talk about sale of shares, it is not limited to sale in the capital market. It's not only for publicly quoted shares. It also includes private shares. So if you have investment in any company, whether it is listed or not, and it is above 100 million within a 12-month period, the gain on that sale will be liable to tax. So it has very serious implication. The question again is, who is supposed to pay the tax and to which authority? Of course, like has been mentioned in the law, for individuals, the gain is payable, the tax on the gain, which is 10%, is payable to the state where the individual is resident, while for companies, it's payable to the Federal Inland Revenue Service. Yes. But there are complications again. But I'm sure, you know, as time goes.
I'm not thinking how the gains on sales of shares, how is it determined, you know, and what do you think triggered this current law at this time? How can you take us through that?
No, that's what we just
yes, you know, I'm talking about the okay, that's how the gain on the share.
Yes,
that's exactly how it is
disposal proceed,
okay,
less the cost of acquisition.
Okay.
When you buy shares in the capital market. So which means the stockbrokers are going to be very relevant in this matter, because individuals don't go to the capital market, don't go to the Nigerian exchange to buy shares. They buy through the stockbrokers.
Yes.
So the stockbrokers must now keep record of who is buying shares through them. Okay. How much it costs, how much they have sold the shares. So if any authority wants to determine or ascertain how much tax is to be collected, they may have to revert to the stockbroking firms.
So this also has an effect,
particularly for those quoted on the exchange. But for private shares, it will be seen in your for companies. It can be tracked from your books if you dispose of any of your investments. Yes.
Because I was thinking what the roles that will be played by stockbroker or the Nigerian Exchange Limited in the collection of CGT on shares at this point.
Nigerian Exchange Limited will not have that responsibility, because they are only used to facilitate, you know, buyers and sellers. Okay, but there are players, which is majorly the investors themselves and the stockbrokers who are their agents. Okay, and it is through the agents that you can ascertain how much has been incurred on the purchase of shares and how much proceed has been generated. So the stockbrokers will have a lot of work to do now.
Quite technical, quite technical here. Now let's now look at the specific changes to the CITA and as you know, the issue of minimum tax rate reduction. Has that been resolved at the moment? That's tax rate reduction. Has that been resolved? Can you explain the new restrictions on capital allowance for exempt income?
Okay, so on CITA, like I said, there are several changes that were made to CITA.
CITA itself.
Okay, the first one you have mentioned, which is the issue around the minimum tax reduction.
Rate reduction, yes.
Okay, the rate reduction was just from 0.5% of turnover to 0.25 for a 2-year period. Okay, there was an error in the 2020 Finance Act, which this has now corrected. So which means the reduction is specifically for 2 years. So what this law has provided is that taxpayer can only enjoy it for 2 years, either on your 2019 and 2020 accounts or on your 2020 and 2021 account. So if you have claim on 2019, you will not be able to enjoy it on your 2021 account. Okay, and for me, I think that issue has been resolved. Now, two, if you go to the capital allowance issue that you mentioned, you know, in the 2019 Finance Act, there was a restriction on deduction of expenses, particularly where the income is not liable to tax. But that provision was not extended to capital allowance. So which means if you are using assets to generate income, and that income is not liable to tax, the capital allowance that you have, the asset that you are using to generate the income, the capital allowance should not be available for other income that are what? That are taxable. So the provision that has been made in the current act is to say that if your exempt income is above 20%, maybe your total income is 100, out of which 20% is not liable to tax, then this provision will be triggered. It means that whatever capital allowance, which will be computed the normal way, but at the point of deduction from the assessable profit of the company on the income that is liable to tax, the restriction will apply, which means the total capital allowance will be prorated based on the income exempt divided by the total income of the company. That is just the provision that has been made. Again, on capital allowance, this provision now applied to small and medium scale company, which, you know, for small companies, they are exempt from tax.
Yes.
Okay, 0%. And so when you remain a small company and you have assets that you are using to generate your income, what the provision has said now is that it is assumed that you are absorbing your capital allowance to the extent of your accessible profit. So which means you will still need to ascertain what your accessible profit is. Whatever the accessible profit will be used to reduce your capital allowance, even though we know that that accessible profit is not liable to tax, so that you don't have accumulated capital allowance that will now be carried forward when the company is no longer a small or medium scale company. That is the specific provision that has to do with capital allowance.
And now the issue around educational institution and increased educational tax rate to 2.5% is also something that pricks me, and it's very important. Is this aimed at just getting more funds for the schools, and or will private entities also enjoy from this? I mean, privately owned tertiary institutions enjoy this facility.
Very, very, very good question. Okay, so we've just heard from what the minister read in the breakdown that education tax has been increased by 0.5%, which means from 2% of accessible profit to 2.5% of accessible profit. Okay, and we have, the education tax distribution for educational institutions. So the first question is, are private companies, private institutions like the Covenant, all those affordable laws, are they even eligible to, are they able to access those funds? I don't think so. They are majorly for public institutions. The second point you have raised, which is in section 23, subsection 1C of CETA, okay, it appears that the word educational, there was educational institutions that are of public character are not liable to tax, provided they are not engaged in a profit-oriented activity. Okay, so but now the way it appears, which is also not too clear, is the fact that the law, they have removed the educational, which means it is now limited to maybe ecclesiastical activities. So they have removed educational activity. So, but the law is not too clear, because they can still claim the exemption as long as they are not taking benefit as promoters. And if you look at most of those private institutions, they are set up like a trust fund to manage the institutions. So the trustees don't take benefit. As long as you don't take benefit and they are limited by guarantee, they are still exempt from tax. So I think that's an area that will have to be reviewed going forward, right?
Let's now go to the increase in excise and custom tariff, including refined petroleum products.
Yes.
Subsidy will soon be removed if we are to follow what the PIA states for us. Now, what could have warranted this step at this time, and what will be the impact on goods, of course, and services and the people?
We know the impact on goods and services. What will warrant it is purely government is looking for revenue. So much so much loan has been taken, and those loans needs to be serviced. That is why the increase of introduction of excise on non-carbonated, non-alcoholic drinks has also, there has always been on alcoholic. Now it is being extended to carbonated non-alcoholic.
Yes.
In addition, a 10 naira per liter is now being imposed on refined petroleum, both imported and locally refined. So, which means by the time subsidy is removed, the price goes up, then we'll now add the excise duty
on it.
Okay, on it. That is, so it's pure revenue generation, and you cannot blame government. So much loan has been taken, and they need to be serviced. But the implications are very clear. Goods are going to be expensive. Transport is going to, transportation, I'm sure it's better imagined.
Honestly, because 2022, they say we should be ready. Well, let's now look at that. You touched on it in your first submission. That's the talking about the significant changes in the FRS Establishment Act. But let's look at it now as it relates to technology and precedence over other laws.
Okay, so in the 2020 Finance or 2019 Finance Act, the FRS was given the power to deploy proprietary technology, which means any platform developed internally. But now they have been allowed, which is applicable everywhere in the world. you cannot be self-sufficient when it comes to technology. You need third party to support you, for you to be able to be efficient in your operation. So this law has now extended that power by allowing the FRS to now deploy third party technology. But of course, there are restrictions there with penalty, okay, such that the FRS must give the taxpayer, room to object if they think they are not ready, or they need time, they need to put some things in place, like some supermarket now, VAT is supposed to be collected, on auto basis, okay, but if they don't have that internet platform to be able to manage it, FRS can give them time to do that. We don't know whether government is ready to support those supermarket and all that. Those are the areas that have been put in place so that they can also make their claim to say that, see, I'm not ready, but they have to give reasons and give a 30 days notice to the FRS. Otherwise, it becomes a major offense, and the penalty is very clear, where you refuse the tax authority the ability to deploy the technology that will make their work and tax collection to be efficient. Again, in terms of precedents, the focus is just precedents as in when it comes to collection of taxes on behalf of federal government. Okay? Collection and administration and collection of taxes. I think this is really targeted at some government agencies like RAMFAC, like EFCC, even the National Assembly were attempting to start collecting taxes at some time. So for them to have passed this, which means we don't expect that they will, because there's a way you extend oversight function and it becomes tax authority. Okay, so by this provision, it is now a criminal offense for any person working in any government agency except invited by the FRS. FRS can always invite EFCC if they have criminal issues or financial crime issue and it's related to tax and they think they need their support. Why not? FRS can invite EFCC and they can jointly carry out such activity, but not that EFCC will now collect the money into their own account or into, I don't know what account. It must be one government account, but not FRS account. It is now an offense to do that. And anyone that is has received letter from such agencies can refer them to this provision and resist and also inform the tax authority. I think we need certainty when it comes to tax authority in Nigeria.
Clarity.
It's a major principle and canon of taxation.
It is all interesting conversation. Almost done. With respect to VAT, how will registration and collection by non-resident companies engage in e-commerce? How will that work?
Okay, so like I was trying to explain, before now we have provision where a Nigerian has dealings with a non-resident entity.
Yes.
The responsibility for the VAT on such transaction was majorly on the Nigerian entity. Okay, so you self-charge and then you remit to the tax authority. But of course, there are several persons that, particularly when it comes to digital transaction, that you do transaction on the online through the internet, and it is impossible for FRS or the relevant authority to track those transactions, particularly when it comes to business to consumer transaction. Okay, so what this provision has said is that it is now the responsibility of the non-resident entity, specifically using Amazon mentioned by the minister. Okay, you buy books through Amazon on daily basis by individuals from your house. Okay, it is now responsibility of Amazon to account for the VAT on those transactions. Okay, and so it's very apt when it comes to business to consumer. But for business to business, the FRS said, well, where the resident entity fail, to self-charge, the foreign entity is required to register and then remit, or that from time to time, FRS will also appoint specific companies in Nigeria as their agent. Non-resident entity as their agent of collection. Okay, all of which is just targeted at ensuring that the VAT due on those transactions are not lost. But it looks a little bit convoluted, particularly when it comes to business to business, because most businesses are registered. If there's VAT, the self-charge, and the remit to FRS. But now you're asking the non-resident entity to also register and collect VAT. So I'm sure there will be clarity by the time they issue circular on some of these things.
And what about the turnover tax of 6% mentioned by the minister earlier today during the budget breakdown?
Okay, so that has always been in Section 30 of CETA, which means where a company's profit is difficult to ascertain, or the profit declared by a company is less than what is expected of such a company, such a company can be assessed to tax on turnover basis. Okay. And in practice, 6% is used, as mentioned by the minister. So what they have now said is that specifically for digital transaction, you know, where you have a server, you're operating in Nigeria, a server is in Ghana, and then we are paying for the usage of such a server and all that. So specifically for those offline and off-site transaction, digital transaction, that it may be more straightforward to just assess such a company on turnover basis, since we are not too privy to the likely expenses they will have incurred in generating their income. And again, when you even insist on them filing returns, you cannot verify other costs they will have incurred outside of this country. Okay, so it is more straightforward to just assess them to tax on the turnover that is attributable to the operation in Nigeria. So that is more direct, that is more straightforward, and makes the work of the FRS easy. The taxpayer too may prefer that, as having to now commission another firm to prepare account relating to the operation in Nigeria. I'm not sure FRS is really ready to do that, but I think that is much more straightforward, because they're still asking companies to also file returns even where they are non-resident.
Very interesting. Now, almost wrapping up now, because I think we've touched on all that. All in all, clarity, certainty, government wants more revenue, and all of that. What's the outlook? What are you looking? What are your projections in seeing how this Finance Act will support the budget one way or the other as a player in the industry? Okay,
unlike what we had last year, there is introduction of new tax. I would say CGT is new tax, but after 23 years, CGT on shares is coming back. And the threshold of 100 million that they have set is quite low. That is not really targeted at portfolio investors. Nigerian investors are also going to be caught by that provision. Okay, so that's a major one. And I'm sure circular will be issued as to the operation, the role of the stockbrokers, the role of everybody will be clarified. Again, you will see some clarity in terms of those FRS Establishment Act to make the tax authority certain. The taxpayer don't want a situation where they have carried out audit with FRS, they have gone to bed following up, continuing their business, and then second day, one agency is also coming to say that we have oversight function. If you have oversight function, go to the relevant government agency and carry out your oversight function, not on private companies that are doing their business. Okay, so I think there's some clarity there, and again, you can also see the urgency in the need for revenue by government. For example, the stamp duty, they want it to be shared now every 30 days. You know, how much has been collected, can we share quickly? You know, those are serious pointers to the need of government for revenue. And of course, if you go back to the custom and excise tariff that has been included, the 10 naira per litre, those have very significant implication, and it shows that government really need revenue, because of course every time we hear about more loans being taken, and then those loans need to be serviced, and the revenue has to be generated.
And one way or the other, this is the only way we can go about that.
Internally generated revenue.
Well, I must thank you so much. Interesting conversation around the Finance Act. Of course, you must have gained one or two things there, understanding it one after the other. And I've been speaking to the managing consultant, Pedabo Professional Services, Mr. Albert Folorunsho. They're breaking it down as it should be for us on the show. Thank you very much for spending your afternoon with us. We appreciate this, Lagos traffic and all of that, but we really appreciate your coming.
It is my pleasure.
All right.